The US dollar index continues to hold firm above the 101 mark, while US indices remain under pressure as investors turn their focus to Wednesday's FOMC meeting. Markets are increasingly pricing a hawkish Federal Reserve tone for this meeting and rising rate hike risks for the September meeting amid ongoing US Iran tensions and supply disruption concerns. This cautious backdrop is offsetting most of the earnings season optimism and leaving Nasdaq and risk sentiment struggling to regain momentum. Hello everyone, this is Razan Hilal, Market Analyst with Forex.com, live from Dubai, day July 28, 2026. As per the CME FedWatch tool, markets are pricing in an over 66% chance for the Fed to leave rates unchanged in July. However, we have rising rate hike expectations for the September meeting with an over 56% chance for a 25 basis point rate hike and over 23% chance for a 50% basis point rate hike, which is keeping the US dollar index supported against major market currencies and weighing on broader risk sentiment, which is also increasing risks for another major drawdown in risk assets before a sustainable reversal opportunity emerges. In line with the persistent US-Iran tensions, ongoing supply disruptions, and increasing Fed rate hike expectations, the US dollar index is holding at a critical confluence zone from a monthly time frame perspective, which is above the barrier that served as both as a support and resistance to price action between 2023 and 2026, also aligns with the mid-zone of a descending respective parallel channel between 2022 and 2026, and also above the potential neckline of a double bottom pattern formation that is aligning with the bottom bound of that 2022-2026 channel, and also the bottom bound of the long-standing uptrending parallel channel since 2008, which is a major confluence zone for the DXY in line with the bullish hold for the monthly RSI above the 50 neutral mark, where a sustained breakout above the 102 mark would likely extend a steep rally for the DXY against the markets, possibly aligning with key levels between 102.80, 104.50, and 107. The 107 would align with the upper bound of that descending channel, where we can have a high probability for pullback risk for the DXY, possibly also opening the way for reversal risk across major markets. Now on the downside, I'm going to drop down to the daily time frame, where we can see the price action still holding above the bounds of an uptrending support, connecting higher lows since May 2026, and the breakdown back below that uptrending support, so back below the 101, and further back below the 130 would open the path to retest the uptrending support, connecting higher lows since January 2026, and defining the broader bullish bias for the DXY across the year. That is near the 99.50 to the 99.30 zone, where we can have either another bullish rebound and continuation for the DXY. If not, a sustained hold below that zone would likely confirm an extended breakdown or a bearish bias shift for the DXY across 2026. However, the major level that can determine a long-term bearish bias shift for the DXY against the markets would be the 97 to the 95 zone, as it aligns with the lower bound of the respected 2008-2026 channel and can open the way for long-term bearish forecasts on the DXY and long-term bullish forecasts for major market currencies and precious metals. Now, while the US dollar index holds near a critical bullish confluence zone, there are various risks on the Nasdaq chart where the price action is holding below the bounds of a respected downtrending channel between June and July 2026 near the 27,700 support, which aligns with the 38.2% Fibonacci retracement of the advance between March and June 2026, and the breakdown below this level would likely extend the drawdown towards the 44% and the 50% near 27,200 and 26,700 or 800 respectively, aligning with the target of that extended consolidation between June and July 2026, and also possibly aligning with oversold momentum risks from a daily time frame perspective last seen in March 2026, so possibly opening the way for a potential dip buying opportunity near that zone. If not, we can be extending drawdown risks all the way down towards the resistance that connected the previous highs between 2025 and 2026. That is near 25,800, near the golden 618 of that advance. However, we still have high probability near that zone. Now, on the upside, should we have price action close back within the bounds of this channel that's above the 28,100 mark, we can be expecting price action to revisit the mid zone of this channel near the 28,600. That was also a previously respected support across that consolidation. And a sustained hold above this level, likely target the upper bound of this channel near 29,100 zone for either another potential pullback risk. If not, we can be building confidence once again towards a definite reversal towards record highs, where the last test would be near the 29,800 to the 29,900 mark for either another major pullback risk or confirmed breakout towards record highs that extend the trend towards the 30,800, 31,700, and 32,700. So that's 1,000 to 2,000 points to the upside. And that scenario would likely be accompanied as well with a possible established resolution between the U.S. and Iran, in line with the less hawkish stance for the Federal Reserve, and of course strong performance and earnings across the mega cap and tech sectors.